Have you ever seen your portfolio drop 10% and suddenly thought, maybe I should get out? Or worse, have you watched it rebound by 20% and felt this overwhelming urge to buy in? Well, you wouldn't be alone, because what happens in the markets isn't just economic, it's not just rational, it's psychological, and navigating that takes emotional intelligence more than anything. That's why Stake and I have teamed up to bring you the Investor EQ series. We'll explore the emotional forces that drive investor behavior and how to control them to make smarter decisions. After all, managing your mind is particularly important, especially when markets start swinging wildly. The VIX is a volatility index, also known as Wall Street's fear gauge, and it reflects just how unpredictable and emotionally charged the markets can get sometimes. I mean, we've all been there. One week it's about AI optimism, the next it's panic about potential rate hikes or global conflict. Stock indices bounce around like a yo-yo, bond yields go all over the place, and the headlines can flip from bullish to apocalyptic almost overnight. And caught in the middle of all this noise is you, the investor, trying to stay rational while all this is going on. But here's the thing, this isn't just about being smart. Even the most intelligent investors fall into traps when emotions start running the show. That's where behavioral finance comes in. It's the study of how your brain is hardwired to make irrational decisions, especially with money. And during volatile times, these psychological biases can do serious damage to your portfolio. So in this video, we're gonna break down 5 of the most dangerous mental traps investors commonly fall into during periods of volatility, like right now, and how to beat them. Let me ask you something. If you'd made an investment of $1,000 and then next week it had risen by 500 bucks, how happy would you feel? You'd feel pretty good, right? But what if, instead of your investment rising by 500, it fell by that amount instead? Well, studies have shown that chances are the feeling of loss would sting way more, relatively, than the gain felt good. It's called loss aversion, and it's one of the most powerful emotional biases investors face. Psychologists have shown that on average, the pain of losing money is about twice as strong as the pleasure of making it. So when your portfolio drops, even just a little, it triggers a wave of discomfort, anxiety, and in many cases, that leads to panic selling. But here's the danger. Acting on that impulse often locks in your losses at the worst possible time. Think back to March 2020. The market collapsed, people freaked out, and they pulled their money out at the bottom. And then what happened? Well, the fastest bull run in history that lasted a solid year and a half. If they had stayed calm, stuck to their plan, and understood that this emotional response was predictable, they might have come out the other side feeling much better off. The takeaway? Feeling fear when the market drops is totally normal, but acting on it is optional. And when you understand why it feels so bad, you give yourself the power to sit tight and make better decisions in the long run. Remember, the market's best days usually closely follow the worst days, and studies have overwhelmingly shown that time in the market beats timing the market. Okay, moving on to our next psychological bias, we have herd mentality. This one is a killer. Have you ever bought a stock just because someone else was? I'm certainly guilty of this one. Back in my younger years, I used to watch a few fund managers talking about what they were buying on YouTube, and like a sheep, I bought this company that I had no clue about and ended up falling from about $3.20 when I bought it to less than $1. Yeah, that one hurt. And maybe you've done the same thing. Maybe it was all over Reddit. Maybe your friends were talking about it at the pub. Maybe you just didn't want to miss out. Well, that's the herding bias, the psychological tendency to follow the crowd, especially in moments of uncertainty. It just feels safer to be with everyone else. But unfortunately, in investing, it often leads you straight off a cliff. Think about the meme stock craze. Herd mentality at its finest. GameStop, AMC, Bed Bath & Beyond. Prices surged not because of fundamentals, but because everyone was joining in the buying spree. Nobody wanted to be left behind. But for every person who made money on the way up, there were a dozen people who bought near the top and rode it all the way back down. The truth is, if you're hearing about an investment opportunity from a mate or at a pub, chances are it's already too late. And the reality is, most of these meme stock investors following the herd copped losses of up to 80%. So why does it happen? Well, herding plays into 2 powerful emotions, fear and FOMO. Fear of doing the wrong thing by yourself, aka fear of being a contrarian, and then FOMO, fear of missing out on gains others seem to be making. But Here's the truth. Crowds don't think, they react. And when you outsource your decision making to what everyone else is doing, you're giving up the one edge that you actually have, which is your own judgment. And here's the other problem. Say you follow the herd into a stock that's flying high, like Nvidia, and then 2 days later, it's dropped 15%. Did a good deal just get better, meaning you should be buying more? Or is there a fundamental problem with the investment and really you should be selling? Well, you won't know because you didn't do your own research into the business, you simply followed the herd. The takeaway? Just because a trade is popular doesn't mean it's smart. In fact, the louder the hype, the more cautious you probably need to be. Recency bias is a real killer when it comes to investing because it often makes investors do the exact opposite of what they should be doing. It's the psychological tendency to believe that the current trend, whether good or bad, will just keep going. This bias shows up everywhere, from financial markets to roulette tables. You know those hot number displays you see in casinos? They're there to exploit your recency bias, the false belief that because a number hit recently, it's more likely to hit again. But statistically, nothing changes, right? Now, in investing, this bias shows up in two dangerous ways. During bull markets, it lures people into thinking that stocks will rise forever, leading them to buy in at stretched valuations. And in bear markets, it convinces people that the pain will never end, causing them to sell out near the bottom. It makes investors do exactly the opposite of what Warren Buffett advises.
A sausage muffin with egg and cheese.
Buy when others are fearful and sell when others are greedy. Take the 2022 bear market. After months of steady declines, a lot of people gave up on stocks entirely, thinking the pain would just continue. But what happened next? A sharp rebound. Same thing happened in 2009, same in 2020. The problem isn't just that trends exist, because yes, markets can move in cycles. The problem is assuming that those trends will continue indefinitely and then making short-term decisions based purely on that assumption. Now you might be thinking, well, hang on. Don't markets show momentum during bull and bear phases? Well, that's a fair question, but when researchers at Crestmont Research studied all the trading days between 1954 and 2024, they found something interesting. Up days occurred 53.7% of the time, and down days 46.3% of the time. And that ratio barely changed between bull and bear markets. So even when we think momentum is obvious, from day to day, it's still basically a coin toss. That's why it's so dangerous to build your strategy around short-term charts or recent trends. They're noisy, they lie to you, and they attempt to break your long-term plan. Instead, anchor yourself to your own financial goals, not whatever the market did last week. Have you ever had a strong opinion about a stock or the market, then found yourself only finding articles or watching videos that agreed with your beliefs? Well, if you answered yes, then you're probably falling victim to the most prevalent behavioral bias in investing, confirmation bias. It's one of the most subtle but dangerous traps in investing because most of the time you have no idea you're even falling for it. Confirmation bias is the tendency to seek out, interpret, and remember information in a way that reinforces your existing beliefs while filtering out anything that contradicts them. And a lot of the time, you don't even realize you're doing it. Let's say you're convinced that the market is going to crash. Confirmation bias makes every negative headline jump out at you. Recession warnings, AI bubble, China slowdown. And the reason this happens is your brain is searching for validation. But anything that points to market strength, strong earnings, positive economic data, central banks stepping in, you kind of just ignore it. You explain it away or simply dismiss it, what do they know? And it works the other way too. If you're all in on a stock because you think it's going to the moon, you'll subconsciously avoid any bearish research. You'll only watch bullish YouTubers. You'll scroll past analyst downgrades. You might even unfollow people who post bearish takes just to protect your own narrative. This bias affects everyone because it's actually one of the most useful biases we have in being human. If we see a bear in the distance that's running our way, we're not going to stick around and consider why it might not be attacking us, right? Even if it isn't, our brains are going to make a mental shortcut and assume we're right, and if we don't run away, we'll be dinner. So there are reasons behind it, but the danger, particularly in the realm of stock market investing, is it creates an echo chamber where you become more and more certain but less and less accurate. You stop updating your view based on new information and instead just dig in deeper. And that's how smart people end up making very, very dumb investing decisions, because they're not actually investing anymore. They're defending their belief. Warren Buffett once said, what the human being is best at doing is interpreting all new information so that their prior conclusions remain intact. So what's the fix? You have to deliberately challenge your own thinking. If you're bullish on a stock, read the bear case. Follow people that you disagree with. Ask yourself, what would need to happen for me to change my mind? That one question alone can save you from major losses, because investing isn't about being right all the time. It's more about avoiding the ones that you get badly wrong. Remember, Buffett's rule number 1, don't lose money. Rule number 2, never forget rule number 1. Let's say you buy a stock at $100 and a few weeks later it drops to 70. You tell yourself, I'm not selling it until it gets back to 100. But here's the hard truth. The market doesn't care what you paid. The $100 anchor, it exists in your head, not in reality. This is the anchoring bias in action. It's when we latch on to an arbitrary number or the first piece of information that we see, and we let it cloud our judgment moving forward. It could be your purchase price, a recent share price high, or even an article you saw that had a particular opinion. And once we've anchored to that piece of information, it becomes the truth for every decision we make, even if we find other stuff that makes more sense. In investing, this shows up all the time. You see it when someone refuses to sell a stock that's clearly in decline, saying, I'll wait until it bounces back. Or when someone holds off buying a great business just because it was cheaper 6 months ago. Anchoring tricks us into treating the past as if it's a guide to the future, when really, markets and companies are constantly changing. Here's a classic example. As the market was crashing in 2008, a lot of investors anchored to the highs from before the crisis. They refused to buy shares, thinking, oh, I'll just wait until the S&P comes back up to where it was. But by the time it did, they'd already missed out on one of the biggest bull runs in history. So the danger of anchoring is that it turns irrelevant numbers or outdated information into emotional benchmarks. It creates hesitation, regret, and ultimately inaction, when the smarter move would be to reassess the situation with fresh eyes. So what can you do about it? Well, whenever you find yourself anchored to a specific number or piece of information, ask yourself, why does this number matter? Is this piece of information up to date? If the only reason is because that's what I paid or that's what the expert said, you're likely falling into the trap. Instead, zoom out and reassess. Ask, what's the business worth today? Or what does the up-to-date research say? Good investors don't anchor to the past, they adapt to the present. Your money doesn't care about your memories, it only cares about your next move. These are just 5 of many cognitive traps that investors fall into, and while we can't completely erase them, here's the good news. Awareness is the first and most powerful step towards overcoming them, because once you understand why you're feeling anxious, greedy, or hesitant, you're far more likely to pause before acting on those feelings. You start to create space between the emotion and the decision, and in investing, that space is where better choices get made. Warren Buffett is not the world's best investor because he's 10 times as smart as us. It's predominantly because he's very aware of these biases and is able to detach from the emotion before making his decisions. Think of this knowledge as part of your investing toolkit. It doesn't guarantee success, but it builds emotional resilience. And over the long run, that resilience can be just as important as choosing the right ETF or the right stock. And remember, each investor is different. The biases that affect you most may be different from someone else. So the goal isn't perfection, it's just self-awareness. Because the better you know yourself, the better you'll handle whatever the market throws your way.